to this segment on ranging markets. Here we will deal with what a range is, how we actually trade range-bound markets, and why we trade range-bound markets, crucially. So what is a range, first and foremost? Well, a range is a sideways moving market where it's neither going up nor down. But we can trade this. Markets only trend 25% of the time. And a lot of people who are trend-based traders actually cut their nose off to spite their face when they essentially don't have a strategy to deal with a range-bound market. As you can see here, it's moving sideways, but nonetheless, price action is very predictable, and we'll certainly show you some examples, or more examples, of this being the case, and how we could trade profitably from doing so. So we've got a level of resistance and a level of support to deal with the top and the bottom of the range. So a range-bound market is just moving sideways. We've established that. And if we wanted to objectively quantify a range-bound market using moving averages, be it the 50 or the 20, we can simply attribute them to be facing towards 3 p.m. on our metaphorical clock here, as in giving to us that there's no momentum to the upside or downside. The market is moving sideways. And of course, when we're moving averages, you don't have to use the 50 and the 20. You can use horizontal levels. They're far better in identifying tradable structure in the markets as well, by the way. So why do we trade range-bound markets? Well, it makes logical sense, really. If markets only trend 25% of the time, then what are we going to be doing for the remaining 75% of the time? Certainly, it makes sense to have a strategy which deals with both, so that we can take advantage of trending markets as well as range-bound markets as well. In trending markets, we deal with continuations, which are essentially high probability, low reward trading outcomes or trading opportunities, whereas in range-bound markets, we are trading reversals predominantly. And where we've got reversals, we've got higher reward. And also, we can trade off hard and soft levels of support and resistance in a range-bound market, so it gives us more versatility there, and we can typically pursue trades which require less maintenance. The great thing additionally about trading range-bound markets is that we don't necessarily have to change our strategy. We can have the same strategy which we trade in trending markets, but just apply it to a range-bound market. So how do we actually trade a range-bound market? Well, it's very simple. Just to give it to you in simple terms, we've got a level of resistance in the worth of price action. We can sell, like we have here. The harder, the better. When I say a hard level, I'm simply referring to a level which hasn't been broken for over a year. So the stronger the level, the better the opportunity to sell. And of course, we can buy if price action is heading down to a level of support, hard or soft, like we have here. We've got an opportunity to buy right there and then, because we can see that this level has held, just like we had in the previous example, to sell. We essentially look for opportunities to sell when we have a level of resistance, and opportunities to buy when price actions reach the level of support. It makes logical sense. So with this example here, we've got pound CAD, and we can see that it's moving sideways, and it has been for the past 2 years. So pure logic would dictate that it makes logical sense to simply sell the price action when it comes into the level of resistance like so, and this level of resistance hasn't been broken for over 2 years, so it makes logical sense, in addition to buying off the level of support which hasn't been broken for 2 years. The bounce is 70% more likely than the breakout, and for that we can get a much higher reward as well. So it makes sense to essentially hedge our bets. So if we look at price action moving into the 16400 level here, we can see it's tested brilliantly on 3 previous occasions. So in this event here, when it came to interact with the 16400 level, we sold, in anticipation of price action simply going back down, reverting to the mean, or going straight back down to the bottom of the range again. As you can see here, it's very likely given its ping-pong motion between the levels of resistance and support. And if and when it comes down to this level of support, no prizes for guessing that we'll be looking to buy. And these are hard levels of support, and we prefer these a lot more purely because they are stronger and reflect a much more embedded market structure than the softer levels. Essentially, hard levels occur at price extremities, albeit big numbers, all-time highs, 10-year lows, all-time lows. You've got the drift. So we can essentially take advantage of the perceived supply and demand at these levels and have a much tighter entry. We can also trade reversals in range-bound markets of soft levels of support and resistance. And this is pound CAD again. We've got a level of resistance here formed, well, for less than a year, but still we've seen it tested and broken over the past, over a series of years, but we can still trade a reversal off the back of it. Even though the reward's going to be slightly less, however, the reward might be less, but we do get more opportunities to do this. So it's a bit of a trade-off. What would you prefer? Far less opportunities with higher reward and trading only reversals of hard levels, or would you prefer more opportunities of weaker levels, but of a smaller reward typically? The choice is yours. Why not have both? So we can see here that a soft level is essentially a level which has been broken before, but also respected before. And of course, when we look to trade an opportunity at a soft level, we do need to weigh up slightly more evidence in favor of it. So how do we trade this? Well, we want a reversal bar, whether it's a pin bar, an inside bar, a double inside bar, and an engulfing bar, just like we do when we're trading trending markets. A reversal on a smaller time frame is absolutely essential. So if we get a head and shoulders or double top in correlation with a bearish pin bar off a level of resistance, then fantastic. Conversely, if we get a double bottom or an inverse head and shoulders correlated with a bullish pin bar reversal off a level of support, then fantastic. Unlike trending markets though, we don't need as many technical confirmations if we're trading range-bound markets, especially if it's off a hard level of support or resistance. All we really need is the price action, whether it's a pin bar, inside bar, double inside bar, engulfing bar, or smash bar, correlated with a reversal on a smaller time frame. Sure enough, sometimes you'll get the additional confirmations like Fibonacci levels, a moving average bounce, a weekly or monthly pivot. However, it's not absolutely essential. So here we go, we've got the chart here. What's essential against which kind of level? So you can see here that a reversal bar is essential for both hard and soft levels. A reversal on a smaller time frame, essential again for hard and soft levels, but additional technical confirmations are a bonus for both hard and soft levels, but they're not essential. But they are preferred. So we'll take a look at Euro CAD here on the daily. We've got a very strong level of resistance here and a pin bar just countering it against it. We can call this level of resistance a hard level because we're here in June and this level hasn't been breached, or price action hasn't been above this level since February the previous year. So it's a very hard level. We've got a pin bar reversal off the back of it here, rejecting it. We know full well that the bounce is a lot more likely than the break. So our argument to trade short here is a lot more convincing than the argument for the buyers or the breakout traders for it to go long. We've got a bearish pin bar reversal, high test, which is essentially a false breakout because the tail is above the level, rejecting a key level of resistance which remains unbroken for a year, qualifying it as a hard level. We're also selling at the top of a well-established range here, and we have a double top on the hourly time frame as well. So this example, we've talked about selling off a hard level of resistance, but what about buying off a... Well, we've got pound CAD here, which has been range bound for certainly over a year and a half, and we're looking at a bullish pin bar reversal off a hard level of support. We can see that price action hasn't convincingly broken out of these levels from July to July, so we're trading as a range simply buying the bottom of the range. And either taking it to the midpoint or the top. And we can see here that we've just got logic in our favor here. Of course, the bounce, as we just mentioned on the previous example, is a lot more likely than the breakout. And we've got a bullish reversal on the hourly time frame, like so. We've got an inverse head and shoulders here. And that supports the fact that the shorter term buyers and sellers, as are the longer term buyers and sellers, are singing from the same hymn sheet. Not only do we have this structural support respected on the weekly and daily, we've also got on the daily a bullish pin bar reversal correlated with an inverse head and shoulders on the hourly. So that's our logic behind trading this one long. So we'll take a look at Aussie New Zealand here. We're selling off a soft level of resistance, and we can see that we've got a bearish pin bar reversal off a horizontal level, a soft level which has been formed over the course of the year, tested as well as broken. And what correlates with this bearish pin bar is a head and shoulders on the hourly time frame. Other reasons which build up the case for this trade is the fact that we're rejecting the 12700 number, and that's it. As we said in the rules, if we have the price action setup, i.e. in this case, it's a bearish pin bar reversal correlated with a reversal on a smaller time frame, then you've got a very powerful heads up, whether it's at a soft or a hard level. If it's at a soft level, then you can expect it to have a lower reward and a slightly lower probability than compared to whether it's at a hard level. However, you get these setups a lot more frequently than if we're just trading off hard levels of support or resistance. And last but not least, we've got the Norwegian krona against the US dollar here. We've got, lo and behold, a bullish pin bar reversal off this soft level of support, a soft level having been formed, broken and respected in the course of the past year. We've got a big number just below it. We've got an inverse head and shoulders on the hourly, and it's rejecting the weekly S2 as well. So we've got a powerful confirmation to go long in this instance. And this is how we trade off harder soft levels of support resistance in range-bound markets. Very similar to trading trending markets in terms of selecting the trade. However, as you might agree, it's that little bit easier because we don't need as many confirmations.